We're going to get started. I just want to thank you all for joining us this evening. JNF Future is very happy to have you all here tonight for tax tips and update for young professionals. My name is Faith, and I am a board member of both the JNF Toronto and the JNF Future Toronto boards. For those of you that don't know JNF Future, we are the Young Professionals Division of the Jewish National Fund. We cater to the under 40 age range generally. We plan a variety of events throughout the year with all of our proceeds going to a meaningful project that we choose in Israel. Although we may have moved indoors temporarily, there are still so many ways to keep our minds stimulated and keep ourselves entertained, which is why JNF Future has decided to offer webinars such as these ones tonight to keep in touch with our community. For tonight's webinar, we ask that you please keep your microphones muted. All questions can be entered in the chat at the bottom of your Zoom screen, and all the questions will be answered at the end of the presentation, unless Neal chooses to sort of answer as we go along, but please put your questions there for him to see them. Neal is the author of the forthcoming book, The Grumpy Accountant. He has been grumpily helping his clients navigate Canada's complicated tax system for the past 7 years. So without further ado, I'd like to introduce you to our speaker this evening, CPA, CA Neal Winokur. Thank you so much for joining us.
Okay, thanks for having me and asking me to do this. Can everyone hear me okay? Okay, so I'm going to share my screen. So you'll let me know if I do it right. Share screen. Okay, so everyone can see this? All right. Okay, so I'm totally fine with people asking questions throughout. So whoever, like if you want to moderate that, that's fine. Or you can wait till the end. I'm going to try and keep it actually pretty short because I feel like the questions are sometimes more interesting and more relevant than what I might present. So I'm going to try and go through this fast and leave a lot of time for questions. So first of all, I apologize for my haircut and my beard situation. My wife wants to give me a haircut and I'm absolutely refusing, obviously. So I'm very loyal to my barber and I will wait for things to open up and get a real haircut. Now, in terms of young professionals, the material that I'm presenting, I'm not sure how we define young. Like if you angle a light onto my head at a certain angle, you can see some gray hair. So I don't know how to define young. I don't know like what the age range of everyone here tonight is. So the tax tips and material that I'm presenting tonight, I think will be relevant for probably most of us, I hope. And if you have questions on things that I haven't presented, we can go through questions at the end. So let's just get started. Just a few basic tips at the start. At the end of my like the last couple slides will be all of the new government emergency benefits because of this whole virus. But the start of this will just go through basic tax tips and ideas that are relevant for normal times and emergency times and will be relevant for the rest of our lives. Unless, of course, my book accomplishes its goal of massively simplifying the tax system, and then some of these would become irrelevant. But for now, these are the most important things. So number one, if you haven't done this already, you should set up your My Account online, okay? Just another thing before we go through this. The material I'm presenting is relevant for individual taxpayers, so individuals, families. There's nothing in here about self-employed and small business owners, because that would require, I think, a whole other webinar, which maybe we could do. But this is for individuals, as opposed to self-employed and small business. So number one, set up your My Account. This link, you could, if you just open Google and you type in CRA My Account, this link will show up. Once this is set up, it's actually really It's really helpful. There's a lot on there. And people who know me know I don't often praise the CRA, okay? But this is one thing they've got right. Their technology has really improved, like their systems have improved over the years. And in my account, you could access the past 10 years of your notice of assessment, all of your most of your T-slips for the past 10 years. You could see your TFSA and RSP contribution room. You could see your tuition carry forward amounts, your account balance. You can make payments through here. There's a lot you can see and do through this. I really recommend setting this up if you haven't already. Number 2, be organized. So whether you use an accountant or you file your own tax returns, be organized throughout the year. You get a tax receipt, you make a donation to JNF, they send you a tax receipt. Keep it throughout the year. Don't wait until the end of the year. I recommend people I tell all my clients, have a folder on your computer, tax documents, whatever, and scan in your receipts and documents throughout the year. You actually don't need to keep original copies. Scanned copies are okay as long as it's legible. But you have to keep everything. Like, just general rule of thumb, you're supposed to keep everything for the past 6 years. I know it sounds crazy, and it is crazy, but you have to keep all documents and receipts for 6 years in case the CRA asks to see it. Another important tip that everyone should know, and you should tell everyone you know, you should always file your tax return even in a year that you have 0 income. Because if you have 0 income and you're 19 years or older, and you file your tax return, you will automatically get back GST credits, and we're in Ontario sales tax credits, without doing anything. You just have to file, it's called a nil return, a 0 tax return. So some people think, oh, I didn't have income this year, I'm not gonna file a tax return. You're missing out on some tax-free money from the government. So of course the government doesn't have any money, they only have money that we've given them or that they borrowed. But either way, they're giving some back. So if you have 0 income, file. Even if you have 0 income, you should file. Okay, so just a few more tips. You should always try and file your tax return on time. A lot of people think, well, I'm receiving a refund, so I can file it late, and there's no penalty, and that's true. But if you file late every year, you're just kind of inviting some CRA scrutiny. And one year you might owe tax for whatever reason, and you might forget. So I think it's always a good habit to file on time. And if you're getting a refund and you file late, you're delaying your refund. Like, the earlier you file, the earlier you'll receive your tax refund. So it's always good practice to file on time. And of course, in normal years, it's April 30th and June 15th for self-employed. And this year, the deadline was extended till June 1st. Which sounds really good, but for us accountants, it's extended tax season by a month, and it's making us all quite miserable and grumpy. But it gives everyone more time. So this year, the deadline is June 1st and June 15th for self-employed. How do you file a tax return? If you do it on your own, you can go to simpletax.ca. That's one website. You could download TurboTax or UFile. And autofill is what you use. If you use TurboTax or UFile or any other CRA certified software, you can autofill your tax return with information the CRA has on file for you. So for example, if you get a T4 slip from your employer, the CRA has your T4 already on file, which is why I wrote the book, The Grumpy Accountant, because it's kind of silly when you think about it, that we have to file tax returns considering the CRA already has the T4. When the employer gives you your T4, they've given it to CRA. But you can autofill your information that CRA has on file. So again, like I said, the CRA has improved their technology a lot, and you should try and take advantage of that. But you have to be careful because their system's not perfect. So sometimes they might have a slip that you don't have, or you might have a slip and it's not on their system. So you just want to double check. A lot of people don't know this, but you can go back in time up to 10 tax years and file adjustments. So sometimes people don't realize that they forgot to claim a certain tax credit or a deduction, and they think, oh, okay, too bad, I'll just forget about it. But actually, you can adjust your tax returns for prior years up to 10 years, and you could do that through your CRA My Account online, or you can mail in an adjustment form, but you could also do it online. So you can go back 10 years. And of course, keep all receipts. I keep reminding people of that because that's very important, especially if you're adjusting a prior year tax return. There is a strong likelihood the CRA will want to see that backup documentation. Okay, let's keep going. So now a little more complicated, just tiny bit more complicated. People always ask me about TFSAs and RRSPs and RESPs and all of these accounts. It's very, very important that if you have money to save and you have a choice of where to save it. So the first thing you should always do is max out your registered accounts. Oh, I wrote save money in registered accountants. That should say save money in registered accounts. And what that means is the TFSA and the RRSP and the RESP is for your kids, and RDSP for those who qualify for the disability tax credit. You put money into these accounts, you invest the money within the account, and all that investment income that you earn within those accounts, there's no tax. So that makes a huge difference over the course. If we're all young here and you have 20 years or 30 years or 40 years until potentially retirement, it's huge tax savings over time, and especially taking into account compound investing over time. So for example, the TFSA, if you were to max out your TFSA every single year, starting at 19 years old when you can open a TFSA, and you never take out from the TFSA, you wait until you're 65 years old, assuming a 5% return every year, you'll have over $1 million in that TFSA. And you could do the same sort of calculations with the RRSP. So the main thing to remember with these accounts is you want to make sure you don't contribute more than you're allowed to. There are limits to what you're allowed to contribute. And you could find those limits on your notice of assessment or on your CRA My Account. But you really got to double and triple check, because sometimes on your CRA My Account, your TFSA contribution room might not be up to date. So you really have to watch out for that. And the way you could, so I recommend my clients, and I help them do this, you want to keep track of all your TFSA contributions and withdrawals manually yourself in a spreadsheet, just to double check before you contribute to make sure you're not over contributing, because there could be crazy penalties. People always ask me, should I put money in my TFSA or my RRSP? Which one's better? And that really depends on your individual situation. So people with lower incomes might be better off with the TFSA, and people in higher income brackets are usually better off with the RRSP, because you get a nice big deduction on your tax return with the RRSP. So I'm not going to go in, there's a lot more details here. I'm not going to go into all of it. But the main point is, if you're saving money, you should always try and save it first in these registered accounts before saving in what's called a non-registered investment account where you pay tax. That's the main thing to take away. And I'll answer more questions at the end, obviously. So these are a couple more complicated things. If, you know, spousal RSP just means, a lot of people don't realize this. They always ask about income splitting. I want to split income with my spouse. How do I do that? So we don't technically have income splitting in Canada unless you have pension income. Like once you start earning pensions, then you could pension income split. But for us, you know, younger people who aren't earning pensions yet, we don't have the ability to just simply transfer income from one spouse to another. But there are things you can do. So spousal RRSP contributions, for example, what that is, that's when a higher income spouse contributes to the lower income spouse's RRSP. So the higher income spouse gets a deduction. You leave it in for 2 years or 3 years, and then the lower income spouse can take it out of the RRSP, and it shows up in their tax return and their income. So that could be beneficial. Like, let's say you're married and you know you want to start a family soon, and one of the spouses will be off work for a few years or something and in a much lower income bracket. A spousal RSP contribution, it could be valuable in that type of situation. Also, interest rate loans, prescribed interest rate loans from a high income spouse to low income spouse, that gets very fancy and complicated, but it allows people to invest money, to have investments in the lower income spouse's tax return, so the income is taxed at a lower rate. And disability tax credit, I'll talk a little bit more about that soon, but if someone has no income and is eligible for the disability tax credit, any other family member, whether it's a spouse or a parent or even a grandparent, they could claim the disability tax credit on behalf of that person. That's a very valuable tax credit. So just keep in mind, if you know anyone who might qualify for that, even if they don't have income, they might be able to transfer it to someone who does have income. Okay, children. So the main thing with kids, there's a few things, kind of the child benefits. Any family with combined net income of under $200,000, so both spouses' combined income is under $200,000, you will qualify for Canada Child Benefits. You have to register for this when the child is born. That's on the, and you can find that registration on the Service, actually on the Service Ontario website. So that is, and it's, the Canada Child Benefits are tax-free, they're paid every month, and they're based on the amount of income you have. So as your income goes up, the amount of Canada Child Benefits that you receive goes down. And the lower income you have, the more benefits you receive. Okay, so RESPs are Registered Education Savings Plans. So if you know that you want your children to go to college, university, any post-secondary education, you might want to start saving for that. And you could put money into an RESP, which means if you put in, let's say, $2,500 each year, the government adds $500. And I think that's up to $7,000. So 500 times 14, 7,000, if I'm not mistaken, I think, but I'm not using a calculator and I'm like losing my head. So the government adds $500 every $2,500 you put in. So it's almost like a no-brainer if you're able to put in the $2,500. The RESP, when the money is in the RESP, you invest it, the investment income grows tax-free. And when the child is ready to go to college or university, the money can come out of the RSP to pay their tuition. And it's taxed in the kid's tax return, and presumably they usually don't have a lot of other income, so it's almost basically tax-free. If you know anyone who's 19 years old or over, they should file a tax return every year, even if they have no income and they have nothing else in their tax return, because they will get GST credits and Ontario sales tax credits, and it could add up to $400 or $500 each year of just tax-free money. So keep in mind, if you have kids that are 19 or going to be 19, or you know anyone, it's very important they should file every year. And of course, people who are in college and university should be filing a tax return every year and claiming their tuition. There's a tuition tax credit, and they need the T2202 form from their college or university. And those tuition tax credits can be transferred to a parent, it can be transferred to a spouse, and they can be carried forward forever. So they'll reduce the amount of income tax that the student eventually has to pay when they start working. So it's very important to remember this. And if you know anyone who's in this situation they forgot, remember you could go back in time 10 years. I should mention that the TFSA and the RESP, if you're a US citizen, you probably shouldn't have a TFSA or RESP. So US citizens usually put the RESP in the spouse's name who's not a US citizen, if you can. Other common deductions and credits, employment expenses. If you work for a company and as part of your job, you have to drive all over the place, or you have to work from home 50% of the time or more, and there's other things as well that I didn't list here, you might be able to claim expenses. A lot of people think you can only claim expenses if you're self-employed. That's not really true, but you have to get the T2200 form signed by your employer, and then you fill it out on the T777 form on your tax return. Donation receipts, obviously that's an important tax credit. You have to keep all your receipts, of course. Medical expenses not covered. I find a lot of my clients forget every year that they're allowed to claim these things. Prescription drugs, dental, eye exams, all the things listed here. You can claim them as the portion that's not covered by your insurance or not covered by OHIP. It's all claimable. And remember, if you're married, both spouses' medical expenses can be claimed by either spouse, and it's usually more advantageous for the lower income spouse to claim all the medical expenses for the whole family, usually. Not always, but usually. And donations, same thing. It doesn't matter which spouse's name is on the donation tax receipt. All of the donations for the family can be combined, and it's usually more advantageous to be claimed on the higher income spouse's tax return. Okay, I'll keep going. So child care deduction, if you have a nanny, if your kid is in any sort of child care or after school care program, day camp, summer camp, all of those qualify as child care. There's no more child fitness or child arts programs. Those credits were eliminated, but childcare is a big valuable deduction and it's claimed by the lower income spouse. Disability tax credit. You don't, I don't like how they named this credit because you don't, when people think of disabled, I mean, I don't know what people think of when they think of disabled, but you don't actually have to be disabled, whatever that means. I don't even know if that's the correct term anymore. But if you go on the CRA website, like I could do it actually through here. This is a very valuable tax credit. So I just want to show everyone. How do I do this? Disability tax credit. By the way, this is how I answer all my clients' questions. I just go on Google. I don't really know anything. I just pretend. Okay, so disability tax credit. Who is eligible? So they have to approve this form. You have to have a doctor or medical practitioner signs this form, Form T2201. It's severe and prolonged impairment. Okay, so it could really be, there's a lot of things that qualify. So you might want to look into this. And it's a valuable credit. See, 8,400, which means 15% of that is what the credit is worth. And then there's the provincial portion. So it comes out to like $1,800 approximately a year. So there's a lot of things that qualify for it. So you might want to look into like things you wouldn't think of. So for example, someone who has Crohn's and colitis, like type 1 diabetes. I mean, there's a lot. Children who might have ADD or ADHD can qualify. So there's a lot of things that can qualify for that. So it's something to look into. Moving expenses are only if you're moving more than 40 kilometers to start a new job or to start post-secondary education. So that means if you have a child who's going to university out of town, they might be able to claim some moving expenses, possibly. But if you're moving to start a new job and you move more than 40 kilometers, you can claim some moving expenses. Of course, keep all your receipts. Investment fees are people who, if you have an investment account, non-registered, like not a TFSA or RSP, and you pay advisor fees, you pay management fees, those are allowed to be claimed. And interest, when I say interest, that's if people who, have a line of credit or any type of loan that they pay interest on, but they use that money to earn investment income, they can claim the interest expense. And legal fees can be claimed if you're trying to establish support payments, like spousal support. So you could claim legal fees for that. A few other random points. I'm going through this as fast as I can so we can get to questions. If you sell your house or your condo or your townhouse where you live, your place of your principal residence, you have to report this on your tax return. This is a new rule that started in 2016. There's no tax to pay because it's a principal residence, but you have to disclose it on your tax return. And people are forgetting to do this, and there are penalties for not disclosing this. The reason why the government made this rule, some people are saying, is because, remember in 2016, remember those days when the housing market was going absolutely insane and a lot of people were flipping houses, and these flippers were, trying to save on tax and pretending that they were living in these houses and they were principal residences. So the CRA wanted to find a way to crack down on this, and the government just made this new blanket rule. Okay, from now on, everyone has to report every single sale of their house, their principal residence, and that way the government can audit randomly some of these claims to see if they really are your principal residence. So just remember, if you know anyone who tells you, oh, I'm moving, I sold my house, oh, congratulations, remind them they have to report it in their tax return. Installments, if you owe $3,000 or more on your tax return for a certain year, the next year, if you're going to have the same type of income, you have to pay your installment. The CRA wants their money throughout the year. They don't want to wait until the end of the year. So It's not a big deal if you don't pay your installments, but there is some interest and tiny, little penalties. So just keep that in mind. The T1135 form is a separate filing from your tax return. And this is if you own $100,000 or more of any foreign property. So for example, US stocks, if you own a condo outside of Canada that you rent out and earn income from, it's basically any property outside of Canada, and it includes, except if it's in your TFSA RSP, then it doesn't matter, but any other investments, US stocks or any stocks from any other country, you have to file this form called T1135. There are severe penalties for not filing this form. But there are some exceptions to the rule. So for example, let's say you own a condo in Florida or something, but you don't rent it out and it's just a personal property that you go to, there's no rental income, then you don't have to report that, and that's fine. But any other property, you pretty much do, and there are big penalties for that. It's important to keep in mind that all these rules and tips and all this advice, by 2 weeks from now, half of this could be out of date, because they keep changing it. They change it, they change it, they change it. And it's hard to keep up to date. That's why a lot of people, even who have simple tax returns, like to use accountants. My personal opinion, this is just my commentary, is that the tax system should be much simpler. I really shouldn't have a job filing individual tax returns. Everyone should be able to file their own return if our system was much simpler. And that's why I wrote this book, The Grumpy Accountant. But as of now, keep in mind, these things are always changing and it's hard to keep up, and you want to make sure you're on top of things, get professional help when you need it, because it's just a constantly changing, it's a piece of legislation. Okay, so I think we only have 2 more of these slides left. So this is now, I'm sure everyone has heard of the CERB by now. This is the brand new emergency response benefit the government just created to help people get through this difficult time. So CERB, you can apply online. I put the link there. You could easily find it. Just go to Google, type in CERB. This link should come up. It's for people who wouldn't qualify for EI because maybe you're self-employed, so you don't pay into EI, you don't qualify EI. Maybe you were getting EI and then the EI ran out and now you can't find a new job because of this whole crisis. So pretty much anyone who might not qualify for EI could probably qualify for CERB. You could read a lot of the details on their website. It's $2,000 a month for 4 months. Keep in mind it's taxable income. So in 2020, if you're receiving CERB, on your 2020 tax return, you'll probably get a slip, maybe it'll be a T4E slip, like EI, and it will be included as income in your tax return in 2020. And be prepared, I think the CRA will be auditing randomly some of these claims that people have made for CERB, because in the application, the CRA doesn't do any sort of check to see if you're really eligible. They just ask you to click a few boxes that you're basically attesting, you're being truthful and you qualify for this. And later on, the CRA might do some random audits and checks. So, it's possible that there are people trying to scam the system, and the government decided that in the interest of trying to get out this emergency money to people as fast as possible, because some people really do need it to pay their rent and groceries, because they really experience a loss of income, the government said, you know what, we're going to give the money to everyone who applies, and we're kind of going on the honor system here, and we know some people will take advantage, but that's why we're making it taxable income, so the government will recover some of it. But just be prepared for CRA audits in the future. It's not really clear. This is totally brand new, and it's not clear how this will play out. Some other emergency benefits that the government put in place. So if you're receiving GST credits and Canada Child benefits, you'll automatically get an increase. You don't need to apply. They just increase the amount. So that's automatic. The Ontario government is giving $200 tax-free for every child. So just if you have a child, I think it's under 12 years old or 16 years old, I forget. You can go on that website. and you just fill out this little application, and within a week or two, you should get $200 deposited into your bank account. Mortgage deferrals, if you're having trouble paying your mortgage payments, you can contact your bank. This isn't through the government, but you just contact your bank directly. And it's not just mortgage payments, but any sort of debt you might have, credit card payments, car loans, and you work out a deal directly with your bank. They're trying to work with people, but you just have to be careful here, because the way they did the mortgage deferrals, a lot of people were very upset when they found out the details, because what they're doing is whatever payment you want to defer, they're adding it to your principal balance and charging interest on it. And that's kind of interest on interest, because part of your payments there's an interest portion. So it honestly might not be worth it to do this. You have to really think about it. Lastly, there's this emergency student benefit. This is for people in college students, college or university students. I think it's $12.50 a month that they're offering for 4 months, but details haven't been released yet, although they might have been released, and I'm having trouble keeping up to date. So you have to look that one up. But if you know anyone in college or university, or they just finished, or they might be starting in September, and they're having trouble finding a job in the summer, so there is this benefit out there for them. And I'm not sure if that will be taxable or tax-free. I don't know. And I think it's $12.50 a month. So for 4 months. So I think that brings us to the end. And I'll take questions now. And of course, if you are interested, my book will hopefully be published in a couple months, 6 to 8 weeks, or maybe a little longer. If you want to receive updates, you can sign up at my website. So I think that's it. And whatever questions you have, I'm happy to entertain.
Great. So thank you so much, Neal. So if anyone wants to either unmute themselves or type your question in the chat, the floor is open for questions. And actually, Neal, I have one myself I've been meaning to ask, but I was waiting to the end.
Okay.
You kept mentioning that we should be keeping our receipts. And, I've heard that from quite a few people before.
Yeah.
But when we're keeping our receipt, is that every single receipt we're using, for example, for all of 2020? Or, if I go buy milk from the store, am I keeping that receipt? Or is it usually for larger purchases?
Okay, so it's only things that you want to claim on your tax return as a tax credit or deduction. So if you have, charitable donation receipts, any medical expenses you're claiming, childcare deductions, you don't have to keep every grocery bill every time you go to Starbucks and buy a coffee. I mean, unless you're claiming like meals and entertainment expense, if you have your own business or something. But when I say receipts, I mean anything that you would claim on your tax return. I forgot to mention like rent or property taxes. There, you can claim that on your tax return as well. On the Ontario, it's called the Ontario Benefits Schedule. So it's for people below a certain level of income. But for that also, you would need to be able to prove like property taxes paid. So your final property tax bill, or rent paid, a letter from your landlord signed by your landlord showing the amount of rent you paid. So those are the type of receipts. Like if you're claiming moving expenses, you want to claim the moving receipt, right? So it's only things that you're actually claiming on your tax return. Does that make sense?
Yeah, no,
okay.
Definitely. Thank you so much.
Okay.
I have a question.
My sister. Okay.
Can you hear me? Does it work?
Yeah.
So let's say like you lose your job, or you can't find a job because of COVID, and then you get the CERB, but then in 2020, later on you find a job. Like, how will the CERB be taxed on the return? Because like, how will they tell if you need it or not based on your income if it was a lot higher after the CERB, right?
Okay. Yeah. Okay. It's a good question. So CERB, the way the CERB application works is you only apply for 1 month at a time. And so for example, you apply for the period from March 15th to April 11th. And you attest in that 4-week period, you have to you click on the CRA box, like when you apply, it says, I earned less than $1,000 of income during this month. So let's say you applied for CERB for April to May, and then you found a job in June, you wouldn't apply for CERB for June once you start your new job, right? So when you file your tax return 2020 to CRA, they're just going to see, okay, you earned $4,000 or $6,000 or $8,000 of CERB, and they're going to see, okay, you have a T4 for however, you know, $50,000 or $100,000 or $5 million, whatever. All that income will get added together. So the CERB income will be taxed, like with all your other income, depending on what bracket you're in, right? So people should keep in mind, if they think they're going to be in a higher bracket, they might owe a little bit of tax. It's the same thing as EI. All my clients who receive EI, for whatever reason, they're very surprised when I send them their tax return, like, oh, you owe $400 of tax. It's like, what? What do you mean? I was on EI. It's like, exactly, right? So it's
Well, on
taxable.
EI, they take off at source though, right?
They take off at source. So CERB, but they never take off enough at source usually. CERB, they're not taking off at source because they want people to have the money. And the government basically, to get people to have the money now, they're going to create a mess later on. Like next tax season, a year from now, is going to be a mess because people are going to owe and they're not going to understand it. But the government said, you know what, like it's a trade-off we're willing to accept because we want to get this money into people's hands now. So if you're on CERB and then all of a sudden you find a job and you realize, oh, I shouldn't get CERB anymore, you just simply don't apply for the rest of the periods. That's all.
So then there's no downside to get it when the temporary period where the person wasn't working.
Now.
Yeah, like if
well,
they get a job after.
Assuming they qualify for it.
Right.
I don't see why. Look, if you have to, some people might have to pay it back. They realize they weren't eligible. I read an article about senior citizens applying for CERB, like people telling everyone in their family to apply for CERB, students, people who had no income. The rule for CERB is you have to have had $5,000 of income in 2019 or the past 12 months. And that's $5,000 of employment or self-employment or EI. So if you had zero income in 2019, you don't get CERB, you can't get CERB. And a lot of people didn't know that and they applied for CERB and they're gonna have to pay it back. So if that happens, if like you basically just hold on to the money and you could try and call CRA and tell them, but the wait times are really long. So, you know, people have been having a hard time to get through to them to try and like sort these things out. Does that answer your question?
Yes, thank you.
Okay.
So you're saying that students who cannot get a job, college students, they're entitled to, is it CERB? Is that what they're entitled to?
It's not CERB. It would be a separate thing called CESB, the Canada Emergency Student Benefit. I'm not fully up to date on that one because they only announced it like very recently and they keep changing the details because there was a lot of criticism of what they announced. So I'm not exactly sure, but it's called Canada Emergency Student Benefit, CESB. And I think it's for anyone who is currently enrolled in college or university, or they're starting in September, or they just finished college university like in December or this past year. I think they qualify. Yeah, if they find a job and they can work, then they wouldn't qualify for it. But if they can't find a job, and even if they weren't planning on finding a job and they weren't planning on working, I think they still can qualify for it.
So does it pay very much? Like what are we talking about in amount?
The student benefit, what they said was it's $1,250 a month, so $1,250 per month for 4 months. And now they might have changed that. They could be changing this. So some of these details, like I'm not 100% sure. If a student qualifies for the disability tax credit, then the amount is higher. I think it's $1,750 a month, $1,750. But for most people, it will be $1,250 a month. I'm not sure if it's going to be taxable or tax-free. I don't know.
Mm-hmm. So how is that different from a CERB? What is then the CERB?
The CERB is $2,000 a month.
How do you qualify for that?
So to qualify for CERB, you had to have been working. You had to have earned at least $5,000 of income in 2019 or in the past 12 months. So it's people who have, experienced a loss of income, like their job stopped paying them, or
Right.
they were self-employed and now they have no revenue, they can't conduct their business. So that's CERB. So the student benefit is only for university and college students.
Right. Okay.
And the CERB is basically for pretty much everyone else who wouldn't otherwise get EI.
Right.
Yeah.
Very good.
Any other questions?
Sorry, we have a question in the chat, Neal, actually. Yeah.
Sure.
So the question in the chat says, since we all want to support the JNF, thank you very much, would you talk about the after-tax cost of charitable donations?
Okay, it's a good question. So let's say you donate $100, you get your tax receipt, it says $100, and you put that into your tax return. Usually it increases, if you're getting a tax refund, it will increase your refund, $100 donation, anywhere from, it really depends on your tax bracket that you're in. But let's say you're in the highest tax bracket, it'll basically be about half. So approximately 45 to 50%. So if you make a $100 donation, really after tax, that cost is really probably $50 or $55. But that's if you're in the highest tax bracket. If you're in the lower income bracket, that amount's a little bit lower. So it might be 30%, 35%, 40%. But that's basically how it works. So you donate $100, you'll get an increased tax refund by anywhere from $30 to $50, depending on your level of income. And of course, keep the donation receipts because CRA loves to audit that. They love to audit people's claims for donations if you have a lot.
Good question. So do we have any more questions?
I was expecting more questions.
I can ask a question because I don't want to. Neal's giving us his time. I just enjoy hearing his voice. I have to ask him a question. It's me, Neal.
This is my brother-in-law, by the way, just so everyone knows.
How are you? You're a little too close to the screen.
Oh, sorry. I'm not an expert at this, okay?
Push back a little bit. One of the things that there's a lot of talk about is this. Did you talk about the Ontario, that Ontario credit, the support for families?
The $200 for
Yeah.
kids? Yeah, $200 per each.
Taxable or is it not taxable?
I think it's tax-free. I don't think it's taxable. Now, I could be wrong. I'm pretty sure it's tax-free. And I already got it. I applied and I got it in my bank account. It took me like 5 seconds to apply. So we can all thank Doug Ford and whoever the Minister of Finance is now.
Apparently there's a big mix-up. None of the parents of children from the Jewish day school systems got their money.
What? How's that? What do you mean?
Just problems with the system.
I don't know what to tell you.
Thank you.
You're welcome. Are there any other questions?
This would be different from what the federal government gives then, the Ontario government?
Yeah, the Ontario government is giving $200 per child. So if you're a parent, you just apply online on the Ontario government website and you automatically get this $200. So it's totally separate from the federal government. There's a lot of other material for all this emergency COVID stuff that I left out relating to businesses, small businesses, commercial rent. There's a lot of stuff I left out. I only today focused on individuals. So individuals and families as opposed to business. So if any of you or you know anyone who's self-employed or owns their own small business, that's a whole other discussion. It's very important, and there's a lot of material that would be relevant for them. But today was just like individuals.
Neal, did you talk about home office deduction?
Not really, because it just frustrates me because it makes people's tax returns more complicated. But it's important, so it's a good question. People now, everyone's now, well, a lot of people are working from home now. So the rule for working from home, if you're, like I said earlier on, I talked about employment expenses. If you work from home more than 50% of the time, well, at this time, a lot of people are working from home 100% of the time, for at least these few months. So everyone on their 2020 tax returns might be able to claim a deduction for home office from their employment income if you're still working. So presumably you'd have to get your employer to fill out and sign the T2200 form for you. Okay, that's T2200. And that allows you, and they have to say that you had to work from home more than 50% of the time. And then on your tax return, you could claim a deduction for home office. And home office means that you get to claim all of the expenses that you incur to maintain your home. You claim a percentage of that, 5%, 10%, 15%. You don't want to go crazy because CRA likes to audit these claims. And you can't claim 100% of your house because obviously that's unreasonable. Technically, you're actually supposed to measure the square footage of your office and take that as the percentage of the total square footage of your apartment or your house. And if you're renting, you would claim the rent and utilities. And if you own, you'd be able to claim utilities and property tax, insurance. You can't really claim mortgage interest, but there's some other, but there's still, you know, utilities and other things, repairs and maintenance, things like that, you'd be able to claim. But again, be prepared. Like I said, you have to keep receipts and keep good documentation and good records because the CRA might audit some of these claims.
So I have another question.
Yep.
You mentioned the CESB for college students, but what if the college student is living in the United States, but she's a Canadian and she's still in college right now?
So, okay, that's a good question. I'd have to look, I don't know. I could try and look it up quickly for you right now. Like, I think they have to be resident in Canada. So if she's not living here, but she might still be considered a resident of Canada, even if she just went to college for 4 years in the US. But I'm pretty sure she might still qualify. I'm just gonna try and look it up, okay? But
and while you're looking it up, can we have your email address so that if we have a question, we could write to you?
yes, you can. It's I'll just put it in the chat here. How do I do it? Here, Neal@Winokur.ca. CESB. I think you have to be resident of Canada. Canadian students studying abroad. Okay, so there you go. I think they would qualify if they're, but they have to meet one of the criteria. So they have to be enrolled in the program, college, university. Yeah, so if she's enrolled in a college, university, even if it's in the US, if she's Canadian, I think they still qualify.
That if she's graduating this year, like if this is her last year, she's still at college now.
Yeah, I think it counts, yeah. Yeah.
Great. So Neal, I think we have time for one more question.
Sure.
If anyone has one more question.
Neal, does the CERB go till October? Do you know?
I don't think it's as late as October. I thought it was just 4 months. So like March, April, May, June or something, July. Maybe
it didn't come out in March though. It came out.
But for the period like starting March 15th to April 15th or whatever, I think for 4 months, maybe they'll extend it. I don't know. Like as of now, I haven't heard anything about an extension. It's possible they will extend it. I don't know.
No, I thought it was October. Okay.
Good question. Okay. So thank you so much again, Neal, for answering all of our burning questions this evening and giving us some great tips. Loved the wonderful graphics on the slides. Very excellent choices. And yeah, if anyone has any questions for Neal, his email is in the chat, but I'll read it out. It's neal@winokur.ca. And thank you so much again. For anyone who wants to rewatch this video again, it will be on the JNF YouTube page if you want to rewatch the tips that Neal provided us. And we hope you all stay safe, stay healthy, and keep your receipts.
Keep your receipts.
Okay, take care, everyone. Thank you so much.
Thank you.
Good night. Thank you.